choose to draw whatever you GM. So I'm going to explain in this lesson one of the most commonly asked questions I get, which is about how do I redraw my range levels? When do I redraw them? If I'm drawing a range, when can I move the range high? When can I move the range low? So I see variations of this question frequently. So here's the simple answer. The first answer is it's subjective, right? You can choose to draw whatever you want to draw. Second part of this answer would be you're not going to draw it all perfectly right at the start, but your goal should be over time to gain a greater understanding, right? So you don't have to right away be an expert in drawing ranges, but over time you should try and reach that level of understanding. So I'll do it on this first, then I'll show it on the actual chart. Using your fib tool, and you've got your 0 to 1, and then you've got your 0.2 either side. So you've got 20% deviations to the upside and to the downside. That's a minus 0.2 and a plus 1.2. So let's imagine price comes down into what looks like a range low and then a range high. Okay, so your question is, where or when do I redraw my range level? If I get a false breakout there and it comes back inside, do I now have to change? If my range low was previously here, if this was previously my range low, and this was previously my range high, right? Do I have to redraw it and move my range low now downwards? Range low and range high. The answer is no or yes. You can do whatever you want. It's entirely up to you. Okay? There are no rules to the market. There is nothing that the market says you absolutely must do this and this happens every single time. Right? The market's ever changing. It's just a balance of people's opinions that they express through taking positions, long or short. So the way I would look at it would be if we had a range level and price went below but didn't close, there was no candle close below the 0.2, right? So there wasn't a candle close below the 20% deviation, came back inside. I would consider that to be a false breakout, yeah? And if you're trading a false breakout strategy, you could enter along there. I wouldn't redraw my range level. Why? Because the fact that it deviated below and back inside actually confirms that your range was right. Understand? You thought this was range low. Okay, well let's step back and think, what does that mean? If this is range low, there's only two things price can do. It can range or it can trend. Right? So if the price came back inside here and then did the same thing at the other side and came back inside here and just did that, right? Well, look at this now, what you have. This is clearly not a trend. Yeah? It's not going down, it's not going up, it's going sideways. So it is a range. So therefore, your original, or wherever you had them, your range low, your range high, are totally valid. You've actually really called the market well. You've analyzed it correctly, you've identified a possible range, and it has respected the range. The false breakouts don't mean the range level has to move. The false breakouts actually prove that the range is valid. Okay? Now, where that becomes a bit more difficult is if you do get these candle closes outside of the 0.2. Right? This is again where you have to make a rule up. At the end of the day, if you're confused about anything, do nothing. I think most of the struggles that new students are having with ranges is that they think or they get a bit upset or agitated or frustrated when they're not able to identify ranges. Again, one of the most common things I hear is, I'm struggling to identify ranges or I miss ranges. But that's totally fine. You don't need to identify every range. You don't need to trade every range. Not every range is tradable. Not every consolidation is a range either, right? Not every time does it form a range low and range high. Sometimes it does one of these kind of compressive type patterns, right? This definitely isn't trending, but it's also not a tradable range because it's not setting highs and lows and giving you entries. So don't worry about not being able to identify or missing them or whatever. If it isn't, and if you want to use this rule of thumb, this is what I do. If it isn't blatantly obvious that it's a range, then don't trade it. Right? It's like if you have any type of setup, if you've got a setup trading Head and Shoulders, right? Not that I would necessarily recommend just that, but let's imagine you had a setup where it was you short whenever there's a Head and Shoulders pattern. Okay? There's a Head and Shoulders pattern, and you short that on this side anytime it presents. Okay, cool. So what happens if price does this? Does the shoulder, does the head. Do you get angry that you didn't short this? Or do you say, no, it didn't form a proper shoulder as I would expect, which would be, let's say, a retest of that level, right? And it just broke down. This isn't a Head and Shoulders. This is still the same result. It went down, but it's not a Head and Shoulders. It's just a random price pattern, like they all are. So you wouldn't necessarily get upset, would you? In fact, you'd actually feel confident in not taking that trade, right? You'd say, no, that wasn't a Head and Shoulders per my system, didn't look like one to me. The data said the price didn't bounce high enough. If it had to come up here, it could have been, but it wasn't. Okay, cool. Ranges are the exact same. If you don't get a range that looks like you want it to look, you don't have to trade it. So if you get ranges like this, and you have a rule that a false breakout must not go below minus 0.2, and it must not go above plus 1.2, and guess what? If it goes below it, then you don't trade it. Simple. You say, oh, this didn't meet my rules. This isn't a simple, easy range for me to trade, so I won't trade it. Because sometimes it'll do this, come down, come back inside, and it'll form an actual range. But actually, what it's showing you by going there, the reason the 0.2 to 20% rule is useful, is that by deviating so far below, it's less likely to be a false breakout and actually more likely to be a lower low before continuation. So for every time that it does form a range, there's probably an equal number of times, if not more, that it fails back inside the range and actually does go lower. Because it was not a range, it was continuation of a trend. Right? So again, don't allow the hindsight to change your opinion. When you start doing ranges and you see this false breakout and you say, I'm not going long on this because it's outside the 0.2, and then you watch as it goes all the way to range high and falls back in and forms a range, your initial reaction would be, oh, I missed that one. No, you didn't. You didn't miss anything. That's hindsight bias. You're allowing the fact that you can see what happened after time to affect your decision pre-trade. Your decision pre-trade, which was to take no trade, it was entirely right per your rules. Nothing wrong with it at all. What happens after is irrelevant. Now, if you really want to understand this, do some testing yourself to give yourself confidence. Do some scenario analysis. Because when this happens, for every one time that it comes outside the 0.2 and comes back inside, there could be 2 times where it does what I mentioned before. There could be 2 times where it fails. Right? And if you went and back tested that, say you found 100 ranges on the 1 hour chart where there was a false breakout that went beyond 20% deviation, you could see what was the failure or success rate. Failure would mean it reaches the other side of the range. So it reaches the range high. That's success, sorry. That would be a successful range reclaim. And failure would be that it makes a new low and it doesn't reach the other side of the range. And you could just simply calculate. If you've done 100 of them and there was 66 of them that were continuation, failures, and there was 34 of them that were successful at getting to the other side of the range, guess what? The correct decision every single time is to not take that long trade. because it only has a 34% chance, statistically, of working. You don't want to take the bet that has lower probability. So you can take it that way. This will, if you're someone who's very data-minded and you like to test lots of things, that will put your mind at ease. That will help you make better trading decisions, right? Or you could just say, if you want to keep it simple, you can just say, I pick a rule and I stick to it. Meaning, closes outside the 0.2, I don't trade it. Closes inside the 0.2, or false breakouts inside the 0.2, reclaims the range, I do trade it. Okay, so that should help with the understanding of when a range is valid and when a range is not valid per your rules. Again, you can choose any rules you want, but that should help you to understand. And then on the topic of redrawing ranges, again, it's the same thing. When should I redraw my range level? Well, you shouldn't redraw it unless it gives you some valid reason to, but it's very rare, right? Because you'll see a range form, right? And you'll have your range high and you'll have your range low, and then it'll go down way below what you'd expect and come back inside. And your temptation, where you had your range low, you had your range high, right? And your temptation is, oh, I should redraw my range low whenever price is here. But why? Again, for the same reason, price can come all the way up here and still be the start of a new downtrend. Low, high, lower, lower high. There's no reason to redraw the range level there. That's you trying to predict the future. Now what you should do, if it follows a false breakout, comes back inside, and you catch a valid trade, you should draw a new liquidity level if you're a false breakout trader, right? You should definitely draw a new level on the wick of that breakout. Because if this range remains valid, and you're trading false breakouts, the false breakout must go below the low or above the high. It must go below the low or above the high. The lowest low and the highest high. Not the range level. Understand that. It's not the range level that you're trying to trade. It's the liquidity. Right? If you're a false breakout trader, it has to attempt to break out. It can't break out of the old range low level if there's a new lower low. So if you're a false breakout trader, the only next trade you could take would be if it did that. Right? And again, that's up to you. And if you're saying, well, what about this? Is this like, should I take this false breakout trade because maybe this isn't a range, this is a downtrend? Exactly. This would not be a valid false breakout trade as the way I trade ranges, because this didn't reach the other side. If your original false breakout does reach the other side of the range and confirms, right? Let's imagine it goes above and does a false breakout the other side. Great. That confirms this range. Then it comes back down, takes out that one. That would be valid because the range high is still valid. The range high has been validated by the fact it reached. It made a higher high. It at least attempted to. If it doesn't, then just look at it. Just zoom out, look objectively and say, wait a minute, what's this more likely to be now? We've got a high, now we've got a low, now we've got a lower high, and we've just made a lower low. So do I want to get long there whenever market structure is telling me downtrend? No. Okay, so that's another way to interpret it. And understand, everything I'm saying here, all just interpretations. You can do whatever you want. You are free to trade however you wish. These are just general ideas. Yeah? And nothing will teach you more than just doing your 100 backtests. Literally every single student I've spoken to who had this problem or this question, I told them my opinion. I answered this question several times. And then I followed up with them or heard back from them after they'd done their backtesting. They said, yeah, after actually doing it, it made a lot more sense. Right? After doing 100 of them, I started to notice patterns. Yes, I understand why a 20% close outside the range is generally not a good place to get long or short. It generally means a broken range. Yeah, not every time, but generally. Yes, I understand how price has to go through to the other side of the range to confirm it. Otherwise, it could be a lower high. Right? And so, I'll get on the chart and I'll show you what I mean. I'll do replay mode so we can watch it happen in real time. Okay, so there's a very good range that formed up here on BTC back in whenever it was, June going into July. So first of all, obviously the question that everybody asks, how do I know it's a range? A range is simply when price goes sideways for an extended period, right? So what does sideways mean? What does extended period mean? That's where you refer to the most recent price action. There's no rule that says once it goes sideways for 11 bars, 11 candles, that's a range, right? There's no such thing as that. What matters is the most recent trend. So look how we were trending up. Impulses with very small pullbacks, all the way up, all the way up, all the way up. Then suddenly, it tries to impulse, but fails, falls back in. Okay, comes all the way back to the origin of impulse. You know about the 75% rule that I've talked about in the other lessons? You know about the market structure break? If you look at the impulse, so find the big candle, right? The last big candle. Every trend has to have some type of breakout candle, right? And just go back to where it began. And you don't have to be super accurate with this. Just look at the impulse area, right? If price goes away from somewhere, comes all the way back to it, that is not a trend. A trend by definition leaves gaps, right? It has to leave some kind of gap, right? There has to be something in between. Sometimes it's a big gap like that. Sometimes, right, it's a much smaller gap. But generally, it doesn't do this, right? You notice how the trends go up and to the right. Or if they're downtrend, vice versa. But if it starts to do this, right, where it's going up and to the right, and then all of a sudden it's there, like that's clearly not up and to the right anymore. And that's where trend lines can actually help. You draw your trend line, you can see that it's broken. Again, don't fall into the trap. This doesn't mean it reverses. This doesn't mean that it's definitely going to go into a range. And this doesn't mean that it's more likely to go up or down. You're not trying to identify direction. You're trying to identify what phase of the market you're in, trend or range. Totally objective. Right now at this point, there is an equal chance of this, or that. Any of those are outcomes. Sideways then up, sideways then down, straight up, straight down. Any of those can happen. Your job is not to predict any of those. Your job is to wait for a range to form that's obvious and then trade it. It's actually the simplest form of trading. The only thing that fucks people up with range trading is the lack of patience. Trends are hard to spot, right? Especially for new traders. Very common that you will spot a trend once it's already in progress. Yeah? And so, oftentimes, especially when you're new, you'll spot a trend probably when it's at the end or very close to the end. It takes a while to really dial in and understand how to spot trends early. Ranges, for the new trader, easy. You simply do nothing until it's super obvious. Right? Now, in practice, that's more difficult because it requires patience. These are 4-hour candles, remember. So right now, from a combination of the 75% rule, right, where if you draw it from the wick, you can see here, if you go from the wick to the high, it's pulled back 75%. If you go from the impulse candle, the interim low, the lowest last red candle before the impulse move, it's also over 75%. So whatever way you measure your 75%, and again, there's no right or wrong way, you can do whatever you want, just be consistent with it. 75% rule says, okay, this could be a range. This is important. This does not mean it's a range. 75% rule is not a trading rule. It's not an entry rule. It's not an exit rule. It's not a rule for your stop loss. It is an early indication measure. It means you are more likely to be in a range than a trend, because a trend should not pull back 75% or more if it is strong. So at best, it means it's a weak trend, and more likely it means the trend is ending. That does not mean we go in the opposite direction. That means the trend has ended and we go sideways. We could go sideways and then go up. It does not mean the trend is reversing. Trend ending and trend reversing are not the same. Remember, it goes range, trend, range, trend, range, trend in all directions. It can keep going up, keep going down. It can reverse twice, 3 times. The market can do whatever the fuck it wants to do. So then, let's get on to the topic of marking the ranges. So always, 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 in an uptrend, the highest single point of your trend is your range high. I see this done too many times the wrong way. So I obviously haven't explained it well enough. If you're marking a range, your range always starts with where you think the top is or the bottom. Doesn't matter if it's an uptrend or a downtrend. If you've watched the Wyckoff lessons, wherever you think the climax is, right? So you saw an impulse, it pulled back all the way, full retracement, back to the origin of impulse, over 75% retracement. Cool. I think this could be a range. I am therefore going to draw my range high at the absolute highest point. It has to be the highest point because you're trying to trade a false breakout. You can't have a false breakout below the high. By definition, it must try to break out. Okay? So that should hopefully clear that part up. A note on this at this point. It doesn't mean you're going to be right. It doesn't mean this is the range high. It means I currently think this is the most likely range high. Please start to learn to think in probabilities or speak in probabilities rather than certainties. The quest for certainty is what's fucking you up as a trader. It fucked me up for years, or for a year anyway at the start. Don't let it fuck you up. If you're looking for certainty, go somewhere else. Because the only thing that's certain about the market is that it is fucking uncertain. And that's the beauty of it. Nobody knows. It doesn't matter how many zeros are on your bank balance. Nobody knows where the market is going over any sort of consistent time frame. Can a billionaire move the market a little bit if they want? Sure. Can they do it over a period of years? No. So, given that knowledge, that the market's uncertain and unknowable and unpredictable, and the fact that tens of thousands, hundreds of thousands, maybe even millions of traders, retail traders, trading in their bedroom, have made money, then we can say, categorically, there's far too much evidence, far too much evidence to dispute this statement. This statement is absolute 100% fact. There are so many retail traders who've made money. Right, smart retail traders. Doesn't just mean YOLO moon boys can all get rich. There is enough evidence of retail traders, which is what we all are, making money, and that the market is completely unpredictable to prove that you do not need to be able to predict the market to make money. That is airtight logic. The market is absolutely unpredictable. Retail traders are proven with tens, hundreds, maybe even millions, certainly hundreds of thousands of retail traders who are profitable. That's too many. That's too large of a sample set to be an accident. Therefore, you don't need to know where the market's going to make money. That should be the greatest thing you've heard all day. Certainly was for me when I fully understood it. So, range high. If you want to call it provisional range high, if that helps, right? It helped me when I was starting. Call it provisional range high. Provisional means it's not certain, right? Provisional is like you're putting a placeholder. Maybe it is. We're penciling this in, right? Depending. maybe I know, get some people, maybe English isn't the first language. Provisional means pending. We're waiting, potentially. Okay? It's good to use that level of uncertainty when you're marking stuff out. Because, again, the quest for certainty is a fool's quest. If you say everything is, this could be a range high, this might be a range high, this might be a range low, this is a potential bullish order block, this is a potential Wyckoff climax, a potential spring, adding that word potential or provisional to your terminology will be so powerful. It will stop this need for your ego to be right. If you say, no, it was only a provisional range high, right? So if price went like that, you're like, yeah, no, it's fine. It was a provisional range high. I had no confirmation. I had potential level. All right. Then, once you get some kind of sign that we might be in a range, so you've set your provisional range high, it's pulled back 75 to 100%, whatever. Doesn't matter how far it pulls back, as long as it's more than 75%, as long as it's back to the origin of impulse, as long as you think the trend that was happening before doesn't seem to be happening anymore. That's all you need to think. Then you mark your range low. And it's right here. Right? Briefly, it would have been here. Okay? It would have been there. You would have been starting to draw it there. Then it got hit immediately there. You're like, oh no, so this is it. You might ask, would that be a false breakout that I could trade? No. You need to have some type of test of the other side of the range, right? Remember, you are provisionally marking out a range. You don't know yet. Certain things need to happen. So, we have the beginnings of what could be a range. So I'll swing back now to that point I said. Why would this not be a valid false breakout trade? The answer is, just the 75% pullback, or any type of pullback, just that does not mean that you have a range. Remember, price not going up anymore doesn't mean it's definitely in a range. Right? Because it could pull back to there, it could go sideways, and then it could just go to new highs. With no range, this was never a range in that instance. It had a high and it had a low, but that's not a range, that's a consolidation. Remember the difference? A range is tradable, horizontal, sideways, gives you entries. A consolidation can look anything like any of these. It could be like a bull flag, right? Could be any of these compressive type patterns. It could come up and do that, like a cup and handle, any of those. Anything like that, that is a consolidation, not a range. Not tradable with your strategy. And that's totally fine. Remember, you only want to trade the ones that are super obvious. So what would I need to see for this to happen? Because we have this low, we have the range high potential, we have the range low potential. If it takes the high, right? What confirms the range for me is testing the other side and failing. Now that can either be if you're using your fib tool, as you should be, to mark your potential range, right? One example of this for me, if it's an uptrend, will be the price goes to the range high and falls back below the mid-range. Because again, if this was one of those bullish consolidations I talked about, where it wasn't a range and it was just going to break out, and even if it came back inside, it could do that. That's still not a range, that's a consolidation. If it comes up to this side and comes back below the 50, that's a range. Because it's tried to go up, failed, came back down. Again, that's just one way of doing it. Works for me. Try it out yourself, see what happens. So why use that? I use this mostly, this idea of the 50, the mid-range, for the instances where price comes up to the range high and doesn't false breakout, right? It goes up there, comes back. Once it then closes below the 50 and you say, okay, this is likely a range. And so if it then went to the range low, false breakout, I would trade it. If it then came up here, false breakout, I would trade it. By this point, you're definitely in a range, right? Now, if it comes up here, false breakouts come back inside, you can trade that. You can definitely trade that. But be mindful that if it comes back in, doesn't go below the 50, you might get stopped out. But that's your first valid time. That's your first valid area where it could be a false breakout. As I said, down here, unless there's a proper retest of the other side, which again, to go back to the fib example, would have to be somewhere in your premium zone. You know about the premium and discount zones from the lesson. Right? Premium, discount. So if it came up into the, if it goes up into the premium zone, sells off back below the 50, you could consider that to be a range. Or of course, false breakout, you can start to trade that. Simplest thing is just wait. You have to wait for some kind of, so this is the example here. Would I take this false breakout as a long trade? No. Because look at how price is moving. This can very easily just be the start of a downtrend. It hasn't even tried to test the range high yet. Right? It hasn't hit the range high level. It hasn't even hit the premium zone. Now there is the first area where I would. So you can see it tests the range high, sells off back below the 50, goes below that level, and does a false breakout. Okay? So there we have it. That could be a false breakout trade. 20% rule remains valid, because remember, at least if you're using the method I mentioned earlier, a candle close outside of the 1.2, the 20%. Candle close is what would constitute a no trade. That's just a wick. The wicks can go wherever they want to go. It's just liquidating people, right? So again, if you want to have a rule where even the wick that goes outside the 1.2 is not valid, that's totally fine. You can again do whatever you want. But this now would be the first point at which I would see a valid range trade. So hopefully that explains why you can just simply wait. So you notice what I've shown here is that by the time you take your first range trade, we're obviously in a range. I don't think anyone who's been through boot camp to this point would argue that this is a trend. This isn't a trend. Over at these points, you could have argued that it was just a short consolidation, it's going to go higher or whatever. Now, it's a range trade. So do you redraw? Well, that's up to you. As in, redraw your range low? I think no, because of what I said earlier. This has confirmed that the range was accurate. Look how well it's respecting your premium zone and your discount zone. Your initial idea about the range was correct. Right? Your range low from over here at this level. There was a false breakout there. Again, some people might take that trade. I would say not enough confirmation of a range yet. But certainly here, that's now a confirmed range. You let it play on, see what price is going to do. Then we'll see about redrawing. So, there we have. So there's our original range low, original range high. Draw all these over. Just dragging these over so we can see them. And there was another false breakout. That would have been the take profit on your original trade, right? If your exit reason was a sweep of the high. False breakouts, then again, I talked about this in the other lesson. If it does a false breakout but closes below the premium zone, generally not a good risk reward, so it wouldn't be a valid trade. Then you push down, and this is one I see a lot. People saying, should I go long? Is this a false breakout? Is it? It's not the original range level. You have a new level it must hit. You now have a new level it must hit on the upside. Right? You must wait for those levels. So you wait and see what happens. Right? And then it does come above here at this point. Again, that comes down to your rules. The candle closed outside. So is your rule a wick only, or can it be candle closes? Again, and I'll finish with this because I think it's pretty obvious now what I mean by ranges and the different ways to play them. Candle close or candle wick, there is no right answer. The right process is the one you follow. So do not take candle wick sometimes and then candle close the others, as long as it fits your bias. You must be consistent. If you have a range trading system that's based off of candle wick as a false breakout inside the 0.2, trade that every time. If you have a false breakout system that allows for candle closes, as long as it falls back inside the range within, let's say, 6 candles, you can trade that too. But understand, they are two different systems. They will have different win rates, different expectancies, and in your arsenal of trading, they will be entirely different. So, in summary, that's a bit of a deeper dive on ranges, when to redraw them, when not to redraw them. In summary of that, your original range low and high, if it is confirmed by a valid false breakout, you don't need to redraw the range low and range high, because the false breakout by definition has confirmed that you are right. But you do redraw a line on the liquidity level if you are a false breakout trader, because the only area that a false breakout can happen is above a high like here or below a low. So the original range high in this example was not valid for any subsequent false breakouts. Once you have the first one, this range high, it can remain range high, sure, but it's not your level to take trades on. This one is. That's your ever do, right? All good. GM.